Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. In today's episode, we look at issues with front running, using the allegations, or actually more like the rumors, against Quant Mutual Fund as a way to explore the issue. We discuss what is front running, how do people pull it off, and how or when do they get caught, how firms like Axis Mutual Fund performed after they addressed their own set of front running concerns, and what we can learn from that, how stock floats and liquidity matter, and why front running might have strangely helped returns while it was happening, why inter-scheme transfers at mutual funds exist, when they're useful and when they're worrying, and then finally, how we're making sense of this issue and what framework we're sharing with friends and colleagues about their Quant Mutual Fund investments. So do listen in. Hi Deepak. So over the weekend, we woke up to see some sort of vague but quite disturbing allegations that things were afoot at Quant Mutual Fund. Apparently SEBI is investigating them or looking into some sort of stuff, and the word front running is being thrown about as well. Now, this brought back very alarming memories of what was it like 1.5 years ago when Axis Mutual Fund faced a similar situation. And I think their funds were among the best performing in the country at that point of time. So, and the more that came out in that case, it looked terrible. There was like some dealer who was essentially, front running, and we'll get to that, and using information to make a boatload of money for himself, and had bought a whole bunch of flats, fancy cars, and so on. And maybe that's why he got caught, because his lifestyle had just become so absurd. But then thereafter, there was also the situation where these same Axis Mutual Fund schemes, which had been doing so well, just seem to not do as well anymore, even though the markets have done fairly well thereafter. So, with that in mind, I just wanted to maybe open today's podcast by asking you, could you talk us through what is front running, of course, and maybe how is it different from insider trading? But the second point also is, how worried should we be? Because this seems to have had a very bad impact on Axis. Quant is the stuff of legends. There's lots of cheerleaders for Quant Mutual Fund in our company as well. So how do you think this could impact things going forward? So over to you.
Thanks, Ray. I think great way to start. Let's do three things. Let's first look at what is front running, and then look at what's happened or what we know has happened so far at Quant, which is very limited anyways, and then look at potential impacts. So the first part is, what is front running? Think of it as if you have information about someone buying or selling a stock in large quantities, which you think at some point has the ability to impact the price by just their buying or selling. You could effectively buy in advance of them or sell in advance of them, and then do the exact reverse transaction. You sell into that higher price. You're effectively making money off of front running. Now, it's not entirely illegal, because sometimes the information that somebody is buying big or selling big is public news. So for instance, the government could say, I'm doing an offer for sale in a public sector company. When they say that, the price starts to drop. So if you have that information the minute they say it, and at the same minute you decide to sell your stock, it's likely that when eventually the government does sell its stock, the price continues to go even further down and you benefited. But that is not illegal front running, because the knowledge of somebody buying or selling was public. And you could defend yourself by saying, I did not do anything illegal by selling in advance of the government, and all that. So there is an illegal form of front running. The illegal form is where you have information that nobody else does. And that information could be because you are in the know of certain large amounts of buying or selling in a certain stock that will definitely move the price, or definitely or meaningfully likely move the price. In general, the information in large fund concentrated funds like LIC maybe, or in say an Axis, in a mutual fund, or in an AIF or something like that, it is possible that people now know that they're going to buy a large quantity of certain stock. That person could be starts off from the fund manager. The fund manager decides that I want to buy a large quantity of a certain stock, and then he passes this information on to the dealers of that particular entity. And then the dealer then farms this information out to brokers saying we want large blocks of this stock to be bought or sold. The brokers now know. And then at some point, you have other entities like the custodians, the fund accounting people, the RTAs, if they may. Everybody knows you're buying this stock at some level, maybe a little bit down the first stream. Now, if this quantity is large enough that you believe that, listen, when this guy buys this stock, it's obviously going to go up like crazy, and they pass this information on to people who then can benefit from the stock, or they buy it in their own accounts, that would be illegal front running. The other important part of here is because SEBI has recognized this is illegal, and this is something called an unfair trade practice in a way. So it is an unfair market practice to do front running because it steals from effectively the person who's actually doing the buying, because they'll have to buy at a higher rate. In the US, some of this is actually being debated hotly because in the US you have people who can read your order. They call order picking. So brokers sell their order flow to, say, a Citadel and all that stuff. Citadel gets to see your order before it hits the exchange. So technically, in that microsecond before it hits the exchange, Citadel could go somewhere, buy a stock, and then sell it to you at a slightly higher price because they know your order is coming. So it is front running. In the US, it is not entirely illegal. In India, order picking is plain and direct illegal. Even a broker can't do it, in the sense of they cannot try to see your order in and say, I'll place my order before. I will come to this. Unfortunately, it has happened in the past in many ways, perhaps not entirely investigated and all that stuff. Now, SEBI is getting more serious, especially in the mutual fund zone, where they're saying it's not custodians of people's money, therefore, you should have proper trade practices and so on. They have discovered in the past in Axis and in HDFC before that. So nobody's made of milk, as the Hindi saying goes, that there have been dealers and individuals who have tried to use this information for their own personal benefits. These are reflective of the individuals involved, not of the mutual funds, obviously, because it's not like, oh, the mutual fund plans to, oh, we manage 450,000 crores of AUM and we earn like 4,500, 4,000 crores a year in revenues. But let's make 5 crores by doing some illegal front running in some small cap stock. It sounds really stupid for a company to do it. So it would probably be the dealers who probably get paid X amount. They actually make 5x or 10x that amount. So it's just possible that some dealer has done an activity like this, where because SEBI is aware, they have said dealers can't do it on their own accounts. They cannot do it in their family's accounts. In fact, sometimes your families, your dependent parents, dependent children, even brothers and sisters who are dependent would come under the same qualification. So therefore, you cannot have these conversations. The area that has moved from here is that people have said, listen, I can't do it in my own account, so I'll use a friend's account, a new set of mule accounts that are created primarily to do this front running. We've seen this in the past where they've used these mule accounts, done the front running. SEBI has actually investigated, found that certain dealers called up certain people and did this front running and all that stuff, and generated some profits. They've disgorged a certain amount of profit. In HDFC's case, they actually made the mutual fund return a certain amount of money paid by the AMCs from its pocket to unit holders, saying this was the actual loss that was made because of the front running, and therefore you guys are entitled to this much, and the AMC is paying for it. So there have been different layers of enforcement on this. What do we know about Quant? Somebody has placed a news article that said SEBI has investigated Quant for front running and also an entity in Hyderabad, which is apparently related. This news was taken as a exclusive from one of the media outlets. And then now, of course, the whole world is worried about what's happening. Quant is a fairly interesting mutual fund because it's gone from 500, 600, 700 crores 2019 to 90,000 crores today. So it's gone 100x. And most of that growth in terms of value has probably come in the last year itself. So it was maybe 50,000 crores last year. Now it's 90,000 crores. It's growing leaps and bounds faster and perhaps taking market share from some of the larger mutual funds. Very regulated industry. It is not out of my realm of imagination to think that in a highly regulated space, when one player is growing very fast, other players, whether they're mutual funds or other players themselves, may be like, listen, this guy is growing too fast. Maybe he's doing something wrong. Somebody has to investigate. push things around and then things happen. And in this regulated industry, it isn't unheard of that even articles of what is doing. I mean, you can't imagine that somebody is doing an investigation. They would actually give you the details of that investigation when they're doing an investigation. It doesn't make any sense that the regulator would, have this information, want this information out at all. If anything, they would be unhappy that this information is out there in the public. But it's possible that some other players will be like, listen, I'm very happy this information's come out. And if this information goes around, it's actually useful. So there is a train of thought that there's corporate jealousy that leads to such activities, such news flowing that as a rumor itself causes a run. We've seen this in the banking system, we've seen this in stocks, we've seen this in other players. Sometimes the rumors are true, sometimes they're not. But at this point, I would say because it's a rumor, we cannot say that something is actually happening anywhere at all. All we know is that Quant has accepted that SEBI has sent it something. Whether that something is front running or not is only a matter of speculation. Let's assume that at some point, we will get more information. That time we can actually comment on what's actually happening at Quant. But I think the greater question over here that people's mind is, listen, there's been an allocation. Should we do something? What is this?
Look what happened to Axis.
Look what happened to Axis. So maybe we should investigate those.
My question to you is, can we look at the Axis situation? One of the reasons people were able to get away with it is that was a unique time. It was during COVID. There was work from home. People hadn't figured out the systems. So some people took advantage, as you said, of the situation and tried and make money for themselves. But then how do you look at the fact that performance has not been as great going forward? Is that just a coincidence? Did this investigation rattle the company and now they had to turn inward? Or did they just become more risk averse, saying, let's play it safe? I think these are fairly pertinent questions only because, I have been getting messages left, right and center saying, what now? What should we do? Could you help us make sense of what happened post front running stuff at Axis?
Great. Okay. So firstly, what happened at Axis, apparently a dealer was doing execution front running. Now, let me explain what that is, because execution front running is different from perhaps other forms of front running. Execution front running is let's say there's a TV anchor, and I won't use Axis in there because TV anchors have actually been blamed for this, right? So an expert who comes on TV comes and say, listen, I know I'm going to make at 11:55 a recommendation to buy a certain stock. It's a very small cap stock, so it's going to go up because there are tons of people who follow my recommendations on this TV channel. And he tells somebody else, listen, you buy at 11:30. At 11:55, when I make this recommendation, immediately after the price will start shooting up, please use that price rise to sell and make a profit, and we can share the profits later. SEBI has actually unearthed conversations from a TV expert sitting in India to a person sitting in Dubai who then uses these conversations on WhatsApp, and some insider of this entire trade has actually leaked all this information to SEBI, and SEBI actually has audio transcripts of a conversation where person has actually done this conversation. So it's the investigation is very difficult to do because you don't know who is doing what and all that stuff. In Axis's case, remember firstly that mutual funds are not like TV expert wala things, right? So they're very, very regulated. So if you want to deal in something, the dealer has to actually talk to the brokers on a recorded line. Every conversation, they cannot even have their own personal phones on at that time, or if they're on, they have to be on a fully recorded mode. So SEBI could actually go and say, give me the conversations, all the conversations that this person has had between 9 and 3:30 on that day. So this execution level, front running is very difficult because you can't call someone and say, listen, I'm selling now, you please buy. But in Axis, there was an issue with COVID. A few years back when COVID was on, people were working from home, and this particular dealer decided it was his time to live the high life. So he decided that because he's working from home and your lines are not recorded, he started making these conversations with some other people. And then when he would make these conversations, since it was not on a recorded line, he was able to say, listen, at 11:44, I'm going to place an order. So he apparently called up one broker and said, put my shares for sale at this price. And he would then call up the other broker and on behalf of the mutual fund and say, listen, you need to buy this stock at this price. Now, they don't know about the presence of each other, but the stocks got sold by one entity which he controlled and got bought by the mutual fund. And because it was a fairly large quantity, a few crores at a time, you would see the price spike up and the profit was made in this personal account of this person and so on. So how did they find out? They found out because I think they got suspicious. Again, now this suspicion comes not because you know anything about the front running. because this person's lifestyle increased dramatically. So, like you said, there was maybe
Flats
something
and
cars, and there was a realistic. I mean, there was a Lamborghini apparently, or whatever it was, something yellow in color. But whatever it is, it turned out to be the failing point.
Well,
where,
he decided to make it easy for everyone.
yeah. So
okay.
I think the minute you do that, you kind of trigger this thing. It's like, so now what happened after that was, of course, the whole thing was found. There was investigations that there was a, like I said in HDFC's case, there was a disgorgement of the proceeds. Here, I don't know what there was fines involved and all that. But technically, I don't think Access did anything wrong as a mutual fund entity. The point was in COVID, you had to work from home,
And someone took advantage
and someone
of it.
took advantage of it. So
Let me direct your attention to then this part. This guy was basically making money at the expense of the mutual fund. He was making profits first in his personal account. So shouldn't he have hurt the returns of the mutual fund?
yes, a very interesting point, and perhaps relevant to the point of what you said afterwards, which is why did Access's performance suffer? And maybe there are two reasons for it. One is nice and one is not so nice. So here is the first part. Why doesn't performance suffer when you have front running, or why, So it's possible for me to say that I could have bought the stock at 108 rupees, but you bought it at 107 before me and sold it to me for 109. So I ended up buying it from you at 109 when I could have got 107. So therefore I could have got a 2% higher performance. I made a ridiculous performance, but I could have made an even higher performance if you weren't front running the stock. Fair, because this is why front running is illegal, because it hurts the investors who are buying and they end up paying a higher price. But let me reroute this conversation onto what might have happened in terms of Access performance itself. Sometimes the concept of front running itself drives up the value of a stock to the point where it makes a lot of profits, because you're effectively having large concentrations of holdings in some stocks, right? So it may not be front running by itself. I'm just saying that the concept of, let's say you give a fund a lot of money. That fund is buying relatively liquid stocks. The prices of those stocks will go up. So naturally you're getting performance. Now, if somebody goes in and steals maybe a percentage of two of those performance, it's not meaningfully high. But what happens is it's the fund flow into the fund itself that's driving up the price. So maybe it would have gone up 40%, but it went up 38. So you don't grudge the person as no percent. What? And that's what people are saying right now about, say, if you went back to Access Mutual Fund at the time when this was announced, they were like, oh, dude, they just made 120% in 2 years. Why would I, how much did they make? Maybe 1% or 2%. So you don't think of this as a major deal.
So the customer tends to be forgiving if the mutual fund has done well regardless.
For the past.
Of course, SEBI should not be, but I get the point that the customer will be like, look, I made enough money. It doesn't matter.
Yes. I mean, it doesn't sound like it's a big deal. So they're also asking the question, listen, he made so much performance despite the front running.
Yeah.
So,
would
he would have made more, but he would have made 1% or 2% more. So I'm almost like, listen, it doesn't sound like there's an organizational problem, which is true. I don't think this is an organizational problem in any case. So the second part of this would be, why the performance suffered after? Now, there's two things that happen. If I'm a manager in a fund, I'm a new manager in a fund where the old manager has been thrown out because there was front running. Or let us say I'm a dealer or a person inside a fund who was making a decision and the old dealer was front running, he's been thrown away. The minute this happens, I automatically get conservative. I say, listen, I don't want to buy these really liquid stock because they can blame us for front running, because my buying can take the stock price up. So let me move money, more and more money into liquid stocks. So I'm going to buy the HDFC banks and the Reliances and so on, just to avoid the nature of the beast, which is front running. So I don't want to be accused. So Caesar's wife has to be above suspicion, wala thing, and so you overcompensate. In the last 5 years or last 4 years, since the Access Mutual Fund case came out, I think more of the gains in the indexes have happened because of small and mid caps. So even if in your small and mid cap fund you end up being more conservative, you've missed a bunch of the rally that's happened in the small and mid cap. We've seen this in many managed funds as well, where if you get conservative in a time when there's a lot of momentum, you're going to underperform. As I've said, Axis hasn't actually lost money in terms of AUM. The AUM has been roughly the same or slightly higher. In some cases, even 60%. But it does have that problem that the performance has suffered because they haven't done as well as the index. Again, the index absolute performance is decent, but they've hurt in terms of relative performance to the index. So maybe part of it is conservativeness, but the other part is important because why did the stocks go up? Maybe partly because so much fund flow was coming into these mutual funds. If you stopped the fresh fund flow in mutual funds and took out money as well, then these stocks have to be sold. You were the primary buyer and you took the price up on the way up. But when you sell, you take the price way down on the way down. So, to a certain extent, your stocks are no longer going to be driven by your own fund flows. So, to that extent, you can't control what happens. As in earlier, you were able to, you knew that there was a float of, say, 5 lakh shares. But off the float, you probably owned maybe 1 lakh shares. It was only less than 1% of the company, maybe 1 or 2% of the company, but you owned like 20-25% of the free float that was out there. When you own a lot lesser of the free float, the stock price may not being pushed up by your buying, and therefore it can either stay stagnant or go down if there's no new player in town that's coming buying your stocks. Combine this with your becoming conservative and going buying these larger cap stocks, you end up with owning a portfolio that isn't as buoyant as it used to be. So, to that extent that is possible, you might lose all the reasons why your performance was stellar in the first place. Not all, but some of the reasons why you are. So, it's possible that after allegations, people will withdraw from your fund, reduce the fund flow into your fund, and therefore make the stocks that the fund itself owns a little bit less. And therefore, the fund's performance kind of coincides with a rough time, plus the managers get more conservative. I think both these aspects have worked against Axis. Now, this does not talk bad of Axis as a fund house because technically it's like, to whatever money you gave me, I invested it. And I invested the way I saw best. But because of either conservatism or the fact that you don't have the fund flows to support your stock anymore. And as an aside, I think fund flows determine short-term moves in stocks. It is earnings that determine long-term moves in stocks, right? So if a fund flow has taken a stock up to a point where it cannot fundamentally justify its own valuations, the fund flow makes the stock stay as high as required simply because there's no selling. It's like the Nestle of today. Nobody's selling a Nestle, so it's not going down. It's not like Nestle India is so much more operationally efficient than Nestle Switzerland that Nestle Switzerland should be trading at, say, 20 times earnings and India should be trading at 80 times. But because in India, the fund flow does not take money out of the Nestle stock and the promoter, which is Nestle Switzerland itself, owns 75% of Nestle India, there is not enough flow to take the stock down. But if there was a big player selling in some of these stocks, you would find that the stocks would automatically start falling. In fact, if Nestle Switzerland decided that it's going to sell 25% of India, I am sure the price to earnings of 60 is not going to be sustainable meaningfully anymore. So India is a lot sometimes about the amount of float that is available in the market to sell. So if there's not enough of a float, you'll pay a premium for liquidity regardless of anything else. So the more liquid your stocks are, the lesser of the liquidity premium you're getting when you hold that stock. So to the extent that that impacts performance, I think you have an issue with, in a certain way, with float. Now, float is probably a least discussed part of valuations because nobody discusses it, because nobody likes to say, I'm buying the stock because nobody else can buy it and very few sellers in the stock in the first place. But it is an important part of valuations in certain small caps, certain mid caps where the promoter holding is very high and so on.
How do you feel about this cornering of the float philosophy of investing or reality of the Indian stock market? I don't hear this discussed as much about, say, the US stock market. Maybe, I don't know why. But the fact that you can corner the float and that is a way of, in a sense, creating a premium on the few liquid shares available, or that can essentially attach a higher valuation to a company. This basically feels that this could potentially be a source of manipulation as well. I know that's not how you mentioned it, but people could artificially create scarcity or choose to create scarcity to increase the value of a certain stock or of their own stock. How does SEBI view this? Does SEBI, I guess there's both as a customer and from a regulator. How is the reality of the fact that float is very much a contributor to company valuations? How do you view this? Both.
If you look at float, let me give you an example of why SEBI doesn't like it. SEBI says 75% of a company has to be owned by non-promoters. So the free float of a company should be at least 25%. But it's not so in certain cases. Certain PSUs, the government actually owns 95, 96% because of the public sector banks. Some of those banks are trading at 47 times earnings today. Now, no bank trades at 47 times earnings unless it's growing like crazy. These are public sector banks are not growing at that much. But yet, because of the relatively small float, the buying interest is more than the selling interest. Selling interest is negligible. Buying interest is a little bit, and that's enough to keep the stock price high. So what does SEBI do? SEBI says this is minimum 25% public shareholding. But when they say public, it means non-promoter. Promoter can have friends who buy the stock, and therefore his actual holding may be 85, 90%. And therefore the float itself becomes a big deal. This is interesting because if you look at the float problem and how it plays into valuations, a lot of companies have their valuation determined by the lack of a float or too much of a float. I'll give you an example. First example would be Volkswagen and Porsche. I don't know which one owned a stake in which one, but at some point, I think Volkswagen was the most valued company in the world because Porsche, or I don't know if it's the other way around, they bought a bunch of options on the Porsche, on the stock. So when they bought the options on the stock, they decided to exercise them. When they decide to exercise them, somebody has to deliver the shares. So somebody has to buy the shares from the market and deliver them. But once they did buy them, they would almost own almost all of the stock. So when people were scrambling to buy the shares to deliver, they made the price rise so much that for a few days, it was the most valued stock in the world. So float can actually tremendously drive up price.
But this sounds like it'll be a temporary aberration and everyone will come to their senses very soon.
Yes, and sometimes it is a temporary aberration of extreme entertainment, such as in the GameStop case, where free float is being manipulated in two ways. First, people who are short the stock are short more than 100% of the stock, which sounds stupid, but it happens in the US very often, where people build short positions by borrowing stock. And, if I buy a stock, I don't know whether it's borrowed stock or actual regular stock, right? So if I buy a stock of 100 shares, I can actually lend it out again. Somebody can take that 100 shares and then sell it back to me. So now I have another 100 shares, but there's no underlying share. So, somebody has borrowed and sold it to me. Sometimes there's something called 140% short interest, which means not only has all the shares been short, there's 40% more shares than the company has ever issued in the first place. That contributes to float. So what people then figured out is that people who are short are extremely short. So if you make the price go up, they're going to have to buy the shares and return them. If they actually buy shares and return them, that's going to rig up the price even more, which means that you can play them using just the float. Nothing to do with company fundamentals anymore. And that's the whole GameStop argument, right? So it's like, it may be a good company, bad company, we don't care, but somebody is short and he's in trouble and we're just going to keep taking the stock price up by buying options in order to make the price go up. And this float that effectively, or the lack of float that effectively will change the dynamics for the company. So making a company go up when it has very low float is very close to manipulation. SEBI has in many cases said that this is just, if you do this by, a low float stock can be like, if I have 10 shares and you have 10 shares, that's the only shares that's available. I could sell you 10. Then now you have 20, I have 0. Then I could buy 20 from you. Then I could buy 20, you could buy 20 from me and keep doing this cross trading at a higher price each time. And since there's nobody else who has any free float who's interested in the share, we could take the price up to some crazy extremes. And people do this. So this is when SEBI says, now you're manipulating the share.
This is some synchronized trading
Yeah,
or
so
something like
circular
that.
trading.
Circular trading. Okay.
So this is basically a result of free float. Because if there was a lot of float, then if I try to sell at a higher price, somebody else will come and say, listen, I'm not going to buy it at a higher price because I'm going to put my order in at a lower price. So there could also be another seller who comes and sells at my price. So higher float does not allow me to manipulate the share quite as much.
So does SEBI, and do you frown on cornering free float as a way to prop up a price? I mean, legally cornering, because you're like, I like this stock, there's not that many shares available, I'm going to keep getting into it. Do you view this with disdain or with disapproval?
Two cases which show what happened. There was a big case in the US called the Hunt brothers silver cornering case. There were two brothers, surname of Hunt. They came and decided to buy silver and bought as much silver as they could everywhere, thinking that they could corner the market and then the price would go up like crazy. They did it successfully for a few years before they realized that people who had silver mines, which were dead because it was useless to extract silver from them in the price that it was trading at earlier, now realized that, listen, at the new higher price, we could extract the silver. They added supply, they added float to the market. So these guys tried to corner the float. The new float was created out of nowhere in GameStop and AMC, not both of GameStop and AMC. GameStop issued more shares and the price was manipulated upwards or for whatever it was. And therefore, more float was added. So the float game kind of plays out. AMC did this twice. So all of these cases, there was new float that came about just because somebody tried to corner the float. In India, I think we've had cases where certain promoters actually try to keep the float of their company low so that they can manipulate it. There was one famous case where apparently, I won't take names, but apparently the promoter, there was a bunch of players that were short using futures and the price was some 600 rupees or something like that. And then the promoter or his cronies called up this person who's short and said, don't be short. We own almost all the float. We can, make you big loss. So he said, no, let's play the game. And then they played this game where within a few days, the stock went from 600 to 2000 rupees in a futures and options stock because there's no circuit limits on this. And on the day of expiry, the stock fell from 2000 to 800 rupees. So both played this game of margins and this and that. So, the idea was there was just these two players and nobody else was playing on the float. So yeah, it's essentially that. I think that is frowned upon. What SEBI did after that was force the company out of the futures market, for one. Secondly, they did an investigation. Of course, they didn't find anything meaningful at the time. So there was nothing to be found. And the squeezes that happened because of no float are sometimes, distracting from the market. So they just make news and nothing really happens. As in, it's not fundamentally driven, right? So it's not like this company is earning a lot more money. It's just that somebody's gotten short squeezed out of the stock. So I think my views on float are, if you use float to manipulate the stock price, is a bad idea. If you're a fund manager that actually invests in a stock saying, listen, the float here is well kept, you could look at me and say, Deepak, that's terrible. What a lousy idea. But you know what? That's made a lot of people a lot of money in MNC companies, in a bunch of other companies in India so far. So I don't think it's blatantly illegal, but I think it's distasteful for a stock to be valued on float alone.
I think that's well expressed. And I think I get it. So it is a fact of life. If it is a contributing factor, you're fine with it. If it's the only factor or a predominant factor, then we're not so comfortable with where it is. There were a few questions I had just written on that in no particular order, and then maybe we'll get to the way forward. How is all this different from insider trading? I mean, front running versus insider trading.
Yes, insider trading is more like trading on unpublished price sensitive information. You can say that front running is also based on unpublished price sensitive information. So in that sense, they're similar. But the difference in insider trading would be that an insider of the company involved. Here, remember, it's a mutual fund that is buying a stock, which is accused of front running in Axis's case. In Quant, it's speculation that there's an investigation going on. But the mutual fund is not the company. They're buying into certain companies, and because of their buying, that company's stock price may be moving up, and some dealer or something is making a possible profit by front running the game. So they're not insiders of the company themselves. So when the insiders of the company know about a certain thing, there may be a deal that's happening that could push the price up. There could be a large dividend that's coming that could push the price up. Whatever it is, if they know of this information which is unpublished before, and then they buy or sell the stock by themselves, that would be considered insider trading. I think the difference over here would be that you are an insider or not.
Fair. That makes a lot of sense. The next two questions that came to mind is, first is this stuff around front running. You've mentioned some famous examples. I mean, the HDFC one, the Axis one. But what comes to mind to me is this must be a relatively common problem, right? I mean, if done in very small quantities and if people don't go around buying yellow cars, I would think that this is something that happens quite frequently at small levels and no one can track it. I just want to know how you would think about it. Or is SEBI, our systems so electronic and becoming so sophisticated that any deviation from the norm or any unusually good track record starts getting flagged?
When I went to Mumbai, early 2008, they said, why would we trust you? Because you have no khabar. You have no news about the company. You have no news about fund flow. Then why would we even trust you? So the answer to whether this has been happening, according to me, it's been happening formally and informally in the oldest parts of it. I'll give you an example. I mean, let's say you're a mutual fund, you're clean, you have a dealer. That dealer says, I have to buy 20 lakh shares of Reliance. And then he goes into the street and says, no, as a mutual fund, you have to use like between 5 and 20 brokers. I don't know how many you have. But if let's say you have to use those brokers, you call all of them up and say, I need a big block of Reliance. Please somehow find me a big block. Now the brokers know that you're buying a big block of Reliance. Now Reliance is too big to manipulate, but I'm using their example just to say what could happen. So let us say there are these big blocks of Reliance that have to be bought, and anybody you call is saying, listen, I'm not selling at this price. I'll only sell if you give me 5% higher price. If it takes the price to go 5% before this block gets executed, and the broker, somebody at the brokerage knows that a large amount of buying is happening in Reliance stock, they can now tell their families, because now you're not regulating at some level, someone downstream, not families, but let's say somebody else, a friend. But even better, you can tell your own customers saying, listen, I have this information that some fund is buying Reliance. I don't know to tell you which fund. And I shouldn't because it's illegal. If I told you that, this is a small piece of news that I can say, oh, heard on the street, big fund is buying Reliance. And I send this note to some of my biggest customers, my institutional customers, who may be other funds, who may be AIFs, family offices, whatever. So they use the information, they buy. Then after some time, I send this information a little bit more downstream to my high-end, high net worth retail customers. So I say, okay, listen, a big fund and family offices are buying Reliance. And then they say, well, oh, this is great, we'll buy. So they buy. And then you release information to the broad public, saying, retail public, saying, our information is that for the last few days, large investors have been buying Reliance. And this is, by the way, this is the exact sequence of things that happen today in the institutional world. So whether it is front running or not, I'll leave it to imagination, but this has been happening for the longest of times. And in the PMS era before SEBI, this is in the 1980s, it was considered completely kosher because banks would know exactly what you were doing, and they would know that you're buying the shares of another company. And because you would tell them, because you would literally like, listen, I'm going to buy the shares of this company, or I'm going to try and acquire this company, or whatever it is. And since the bank would know, they would run PMS schemes for other people where they would, front run people out of existence. And there was no SEBI to even tell them this is wrong. And for a long time, even SEBI did not have any very well defined rules. So you ended up with people thinking that front running is completely legal. And then, there's still probably a little bit of, okay, so what is illegal about some of these practices? But it is so entrenched as part of our system that even today, if you ask people in certain pockets, they will ask you, what do you know that other people don't know? As if that's a good thing.
Fair. I don't know if this question really belongs here, but you had mentioned this in the past. Mutual funds, and I think Quant in particular, but we don't have to bring it to Quant, often do these inter-scheme transfers, right? I mean, when they move from one fund to the other. Is this a red flag of some sort? Does it mean much? Is it a way of avoiding bad news? Or if the stock keeps going up, all is well. Do you have anything to say on this?
It's interesting because of multiple aspects. I think for one, let's look at it from perspective of, let's say, Quant or many of the mutual funds, you'll find that some of the companies that they own in one fund, then they transition it to another fund, transition it to a third fund, and so on. This is also done sometimes for liquidity purposes because maybe a concentration of small caps in one fund has gone a little too much. You might want to move some of it to another fund, so you might sell from one fund and buy in the other fund. This is a normal inter-scheme transfer saying, I don't hate the company. I want to keep it. It violates certain norms in one fund. And I don't want to go and sell it like crazy in the market. So I'm going to sell it in one fund and buy it in the other fund because I think the price is okay for purchase. All these transactions happen on the market, but the ownership may move hands from different funds to different funds. It is borderline illegal in debt, where sometimes they take illiquid debt and dump it onto a FMP or something like that, which is a fixed maturity plan, where the investors in that fixed maturity plan have no idea what's going on. They can't even get out. There is only one equivalent in equity funds, which is usually an ELSS tax plan, where you can't get out before 3 years. So if the fund manager in a tax plan decides to buy really liquid stocks, you can't do anything about it. And even if it's because the fund needs the more liquid stocks, in some of its small cap funds, it could actually make the tax plan buy the illiquid stocks and provide the liquid stocks in the market that allows the fund that is seeing liquidity constraints to be able to redeem its shareholding. And because it's a temporary aspect, this may happen maybe in a few funds sometimes. You find that there's a lot of redemptions that happen maybe 3 or 4 months in a row. You'll find that the fund house moves the holdings to the tax plan. And then after some time, when things normalize, the tax plan will sell those stocks over a period of time and change back into larger caps. This is a normal practice. In some cases, you may consider it a bad idea, but remember the fund has a positive view on the stocks. The only reason they were looking to sell those stocks, and we should analyze this from a quant perspective as well, is because somebody wants to exit their funds. So they are being forced to sell a stock that they like. And because the market would have already taken the prices down, you're selling into a bad market. So certain times you just don't have the liquidity to sell. So when you transition it from one plan to the other and bring it back, you could argue that the fund is doing the right thing because it likes the stock and believes the stock is actually a better buy at this price. But in order to provide the liquidity, so the liquidity is available, but at a much lower price than you would want that liquidity to be available to. And you consider that price to be a good price to buy. So you just replace the holdings in another fund with this one. Again, quasi illegal, you might say, but I don't think it's illegal because let's look at this way. If I'm running fund A and fund B, and fund B is a long term fund. In fund B, I only have large caps today. And fund A, I have a lot of large and mid caps and small caps. And I get a lot of redemption in fund A, and the market is down. Now, the fund B has long term investors who are not going to remove their money. Fund A is seeing a lot of redemptions. I'll sell the large caps, give them some liquidity. I'll sell the mid caps, give them some liquidity. What about the small caps? I don't want to sell them because the market is actually weak, and I know that this is a temporary phenomenon. I've seen markets, and I know that markets sometimes are slaves of liquidity, and it's just liquidity that's driving these prices down. So what I do here is that I sell the holdings of the small caps at the low prices to my long-term fund and provide the liquidity to my investors who are exiting. So the long-term fund then buys it. But how does the long-term fund get money to buy it? It sells some of its large cap holdings and buys a small cap, because relatively speaking, now the large caps are less attractive than the small caps because they can go up a lot more. So I buy the small caps into my long-term fund and I give the liquidity to the fund that are exiting. Once the crisis is over, prices normalize. Then I can rerun my fund A into the more aggressive fund that I was always creating it at. And my fund B has seen a huge jump in value because the small cap stocks which were undervalued have gone back to reasonably valued or maybe overvalued. So this is a normal function of operations. I think if you replace my fund B with Shrey's fund B, and Shrey is an independent fund manager from me, I could literally call you and say, listen, I got these stocks, man. I got to dump them in the market at this price. Will you take? You'll be like, dude, done. I have a bunch of large caps. I'm going to sell them and I'm going to take the money and buy it from you. So this would be perfectly legal, right? It's just that if we are in the same fund house, somehow it becomes illegal. So I don't think it's a illegal thing in the first place.
No, I get it. So again, it kind of goes back to that float argument of yours. That if a neutral third party would have also been like, this is a good deal, then obviously this makes sense. But if the only people willing to buy that other fund manager who's also your good friend, then maybe
I don't know how to make that
distinction. Fair, I get it. All right. So that was a thing on inter-scheme transfers. I'd like to actually just come back to Quant for a bit and then maybe just bring it to us. So on Quant, look, Quant has become a really big deal. It has a spectacular performance, great growth. And then there was some very flattering or perhaps confusing press about it a week ago where people talked about how the founder hadn't taken a salary for a gazillion years. And I'm not sure what the point of that article was, but it did seem to get a lot of attention, both good and bad. And I was wondering this, at some level, these allegations, I mean, we'll wait and see how this plans out, but kind of reminds me of how people used to keep going up to Zerodha in the early days saying they're growing so much, something must be wrong. They must be making money off their customers in some not so kosher way or whatever. And in the end, I would say that nothing really came of those allegations. It was often just people not understanding how this growth happened and saying, how can anyone possibly do this differently from me? So do you feel the element of that over here? I mean, or anything about Quant being a different kind of fund house, having a different investment philosophy? How does that, do you think, factor into the thing happening today?
So to the extent that we are aware, I think we are not aware of anything about what Quant does. So we did try to decode some of the momentum performance because we have a momentum. And we said, okay, how does Quant momentum actually get its returns? And we ran a few algorithms and we found out something that is almost very close to what Quant seems to be using. So the idea would be to replicate its daily equity curve, right? So if we're able to replicate its daily equity curve very closely, maybe a small difference in terms of execution prices and all that, so then I think we would come close to that strategy. And we did find some. So there doesn't seem to be this funda that says, oh, well, they're doing something. If you could replicate it independently using just the prices of their NAV and run an actual quantitative algorithm on it, then it's fair.
Yeah, they're just good at their job.
They're just good at their job. So I think it's a great discovery for us because it helps us build our thought process as well. So this is, this is a case of one because we've been able to do it in one fund which we know is quantitative in nature. The others are not quantitative in nature because they're subjective. So we're not able to. So are there different funds where they may be doing things differently and therefore is their return not kosher or whatever? I don't think that's the case because you see the stock, some of the stocks that they own. The difference between perhaps many of the other funds and what Quant did was it always maintained a certain amount of liquid stocks even in its small cap fund. So in its small cap fund, its largest holdings is Reliance and Jio Financials. Reliance is a large cap, Jio Financials is also a large cap. But why would you have such a big large cap? Because you have 90 positions. Out of those 90, about 70 or 75 are probably small caps. They account for 65% of the fund. And the remaining 35 within the 10 or 15 large cap names. The large cap names are there to provide liquidity. They're not there to enhance performance of the fund. The idea is if liquidity moves out, they will be able to sell those larger cap funds and larger cap stocks and provide the liquidity. What does that do? That makes the small caps a bigger percentage of the fund going forward. This is not a bad idea because if you're getting redemptions, you're not hitting the small caps where the liquidity may be a problem, you're hitting the larger caps. Meanwhile, when you start getting those redemptions, you might say, listen, I am getting redemptions. Let me try and start selling slowly the small caps that I have so that I don't disturb the price. The only problem with a small cap low liquidity is the price is it will get disrupted. So if I'm selling smaller quantities, at some level, I may not disturb the price. So when people say that this particular stock will take 5 days to sell, if Quant tried to sell off all of it, the answer is, you know what, the first 4 days, it's going to provide liquidity by selling Reliance. And the fifth day, it would have actually been able to sell this stock, so it can provide the liquidity on the fifth day using this stock. So they actually have laddered their small cap funds, which is the largest fund with 22,000 crores, with stocks like this. Now, if you start looking at this versus maybe, I'll quote another fund here called Franklin, which did it in its debt fund, where it had redemptions and it couldn't meet those redemptions. The problem there was not that the bonds that they owned had low liquidity. The problem was that their bonds that they held had no liquidity. That means there was zero people in the entire world who wanted to buy the bond at that time. So they literally could not sell it. Here you can sell it at a price. And if you try to sell more of it, you would get a lower price, but you would get a price. Here, in the case of Franklin, there was actually no liquidity. So they had to shutter the operations of their funds, whereas I don't think that would be similar in an equity world. We have seen this crisis happen before, even in Axis and so on. None of that caused any meaningful damage to the market or even to the stocks that they owned. They just had to, recalibrate their stocks at different time. So I think the idea that Quant did something wrong in the past is probably not. They did something different for sure because they did do a lot of quantitative thought processes. We know this because we are also a quantitative shop in terms of trying to use a lot more of market data to determine what we should be doing next. But I don't think there is any evidence of them saying that they've done something illegal or wrong. Their performance has been so stellar in the last few years. But that doesn't surprise me because in every era, there's always one company that does stellar performance. HDFC Mutual Fund was doing fantastic between 2007 and 2009. IDFC between 2013 and 11 and 2013. There was Mire for a while, about 3 years, all its funds were doing fantastically. Then there was Axis. Now there is Quant. So I am not surprised that one fund is doing very, very well. So, there's a Hindi song saying, "Apna time aayega." So every fund has this "apna time aayega" situation, which is what's happening possibly right now.
Coming to this, I think I have last few questions to end the thing. So first is I'd like to just bring it to us. We're too small to move markets, I guess, luckily at this stage. But even we have some concerns and we've put in place some policies. There's no phones allowed or whatever to prevent front running. But maybe you could just talk for very briefly, because I doubt people are super interested in a small PMS and how it does this. But how do we kind of tackle this? But my question here is also, I've actually found a situation where there is, if I'm correct, semi-public information. Let's say you want to buy a stock or sell a stock, and we only get halfway through buying or selling it on day one. And then everyone goes home for the day. This knowledge is now fairly public. Your broker knows, your custodian knows, everyone working there knows, everyone working here knows. And now they're back home when there are no phones being restricted and no phones being tapped. I mean, this sounds like it's impossible to be able to stop this. No one's going to be foolish enough to do this in their own name. So how do you deal with these situations? How do you think about this situation?
To be fair, the mutual fund, there are a lot more players, right? There's a fund accountant, there's a custodian, there is a RTA. All of these guys know that there's a lot of redemptions happening. Could they not look one level ahead and say, okay, he's going to have to sell these stocks, I'm going to be able to sell them? It is not really unpublished because a lot of this information is quasi-public, but the fact that you use this information before it was actually public and then use that could result in front running. So in our case, you can never avoid the fact that there can, at any point, be some kind of front running. If I have decided to buy this stock, is it possible for me to buy it in my account? Of course, it's possible for me to buy it. But why would I do that and tarnish the reputation of a firm we've built?
That's you.
That's me.
But then,
But let's
as you
say that
said, it
somebody
will
else.
not be the founder.
Correct. Won't be. But let's say there's somebody else, and that somebody else is trying to do something like this. The only way we will get an indication is this is a lifestyle change, like the Lamborghinis, stuff, for instance, which might give us a trigger signal to kind of go and investigate. But beyond that, there's nothing, right? But there is some things that you can. For instance, one of the execution problems in any place is that you have to call a broker and say, I need to buy this stock. Now the broker knows. Now he can go and front run you for kingdom come, especially if you're buying a really small micro cap and you're telling him, listen, I want to buy 5 crores of it, but please buy 10 lakhs of it every day for the next 50 days. He'll be like, oh, this guy is buying 10 lakhs for the next 50 days. I have a guaranteed buyer. He can go and tell his institutional customers, tell his HNI customers that, oh, Deepak Shah is buying some stock. And it may not be a whole amount, but even at these small amounts, there may be people interested in making killing off of say front running. But in our case, what we do is we do direct market access. So what we effectively do is with the broker, we actually use an API and an algorithm we've built in the POS that goes and sends small, tiny orders all through the day. So nobody can determine how much I'm buying at any given point. So it's not like, oh, Deepak is going to place an order at 12 o'clock, because a broker can know that, right? He'll say, listen, I know when I'm going to place this order. So therefore, when I place this order right now, or the dealer can do this, right? He can say the order is at 12 o'clock. So he can do a front run at 11:30 and then, do this. In our case, we try to avoid this by saying we'll use a VWAP algorithm. The VWAP algorithm just trades all day using certain kind of these things with price bands of 5% up and 5% down, which means if you drive the price more than 5%, you don't want to buy the stock. Then the fund manager actually has to go back and say, listen, do I really want to buy the stock at more than 5% up? This decision is also recorded. So saying that he actually changed his decision from saying a 5% band to a 7% band or 10% band at such and such a time. This means that we have recorded evidence of everybody doing what they're doing. So if they ever get caught in some kind of a case, we actually know we can trace the dots backwards. But also that because we place these tiny little unknown orders, they could be a quantity of 1 share, for instance, sometimes that goes sometime, and 5 shares that go another time. Because even I don't know, for instance, right now, and it's the middle of a trading day, what orders are going in which stocks at which time of the day. It's a little more complicated to do execution level front run. Of course, I could go and do some really tiny cap stock. Like its whole market cap is 200 crores and I want to buy some 10 crores of that stock. I'm allowed to because it's 5% of the stock. But I know that if I were to buy 10 crores of a 200 crore stock, I would probably make its price go berserk. At which point there could be this allegation of fronting. So one way we do this is sometimes just to avoid the really small market cap stocks where we end up being more than 1 or 2% of a stock in the first place. Now we're too small to matter. But when we grow, we will reach a point where we cannot avoid being 1%. I mean, if you have 30,000 crores in a small cap fund, and if you have 100 positions, that's 300 crores per small cap. And if a small cap's got 5,000 crores, you're 8% of or some, 6% of the stock. So you can't avoid it because that's the nature of the game. But I think you can change the execution sequence to say, listen, my execution is going to be random, it's going to be an algorithm. And I believe India should actually get its tech guys to work together to build a completely open source, randomized VWAP algorithm that can place orders at random without anyone being able to decode how much shares it's going to buy at which point in time and how. So if you could do that, you would solve some of the execution front running problems across the mutual fund industry.
That actually does sound interesting. Of course, I'm sure there will be some people who figure out how to game that as well, but we'll keep the thing moving forward.
I mean, it's open source, so the idea is somebody games it, it gets fixed for the next time. So
fair. I'll actually then end with pretty much the question that everyone's been asking me nonstop since yesterday. So I've had a great run with Quant. What should I do now? This is a bit worrying. You've talked about how things could potentially impact them. Should we sell? Should we hold? Should we buy more if things fall? People are curious.
So I think a lot of people have asked me this question from yesterday. And I think the best thing at this point is to wait. Because there's a big difference in this versus a situation in, say, a company which receives an order that comes from the enforcement directorate. You might just say, listen, this is one of my companies, but I don't want to take the risk in this company anymore and I want to move out. So it's a small part. Usually mutual funds tend to be a larger percentage of your holding than anything else. And because they're, holding like 70 or 80 or 100 stocks, you tend to be diversified through them anyways. In this case, I would say wait, because you want to see the impact of what it is. Because right now there's a bunch of rumors, there are a bunch of people acting to try and sell. You're thinking, listen, maybe if they sell, they'll get out first and I'll get out second and I'll get a lousy price. Meanwhile, there isn't as much talk of people buying. So there could be this point where people slow down their fund flows. I would say do nothing of this one. Stick with it. And then when you get an indication that certain things are happening, certain things are not happening, then you take action. When you have something more concrete to talk about, because it may be a larger chunk of it. If it is a very small part of your portfolio, and if this concept is bothering you, you should just exit. Because at some level, you cannot have more stress by buying a mutual fund, which was designed to give you less stress. So if it's giving you stress, exit. So I think I would say that for whether it is Quant or whether it's Reliance or whether it's HDFC, why would you buy an investment that, is giving you stress? But at some level, there will be a point which says, listen, this is just way weird. And if there's something wrong, SEBI is going to throw out an order. We're going to figure this out. Even if you're sold Axis at that time, right? Or if you hadn't sold it at the time that it was announced and you waited till now, you would have made a fairly reasonable positive return. It's just that you would have been underperforming the index by like 1 or 2%. This is not like a world shattering. When the index has gone up 140% since then, or maybe the index gone up about 70-75% since then, if you lose 1.5 or 2%, it's not the end of the world. So I don't think the mutual fund regulatory ecosystem is so bad that you would end up, losing so much money that you're going to be disappointed for life. So I think there's a little bit of trust factor in the system at this point, where you would say, okay, the system is going to create a situation where it's going to protect me. And I do not think, like Franklin, that Quant is ever going to have to say, I will not allow you to redeem. That is just not going to happen in my view. So given this, I just feel it's better to wait.
So we're recording this on Tuesday, June 25th, and I hope that those words prove to be prophetically true. So thank you so much, Deepak. Well, that's our show. Thanks so much for listening. If you like how we think about markets and would consider investing with us, then do visit capitalmind.in to learn more about our PMS service, where we offer both passive and active strategies. Till next time. Well, everyone, thanks so much for listening. If you'd like to hear more of our episodes, then do visit capitalmind.in/podcast or just look for Capital Mind on whatever app you're listening to this on. If you have more than 50 lakhs and you'd like to invest them in the Indian stock markets or equity markets, then visit capitalmind.in to learn more about our portfolio management service, where we have offerings starting from 0.25% a year to 1% a year with no performance fee. Till next time.